Welcome, everyone, to this deep dive into the, well, pretty exciting world of investing. Today, we're tackling a big question, one I think is on a lot of minds. How can you potentially double your money in the market?
It's definitely a hot topic. And we're looking at some really interesting analysis today. An experienced analyst recently shared some insights suggesting potential
Yeah,
opportunities.
opportunities with average expected returns around 98%, which is a wow. And some individual stocks potentially soaring even higher, maybe over 120% in the next year or so.
Exactly. But, and this is crucial, it's not about just, guesswork or pure luck. This analysis is based on a strategic approach.
Right, so our goal today isn't just to list stocks, it's to unpack that strategy. We want to show you how identifying the right sectors, the ones poised for growth, is often the key first step.
That's the core idea. Finding those high-performing individual stocks becomes much, much easier once you know which broader areas are thriving.
Absolutely. It's not like throwing darts at a stock list hoping you hit a winner. It's more about understanding the big economic currents, wouldn't you say?
Precisely. Think of it like trying to find the best fishing spot. Do you just cast your line anywhere in the ocean? Or do you look for areas where you know the fish are concentrated?
That's a great analogy. Sector analysis is basically finding those high concentration zones for investment opportunities.
It really helps focus your research. Instead of sifting through thousands of individual companies right away, you concentrate on the areas where the economic winds seem most favorable.
Makes sense. It gives you a much more targeted starting point for making those investment decisions rather than just feeling overwhelmed.
You need that big picture view first. Then you can zoom in.
And looking at the current climate, some sectors seem, well, better equipped than others to handle these economic headwinds, right?
That's definitely what the analysis suggests. Technology and healthcare, for instance, stand out.
What's striking about them?
Well, unlike some other areas, they're actually still showing profit growth, even with all the economic adjustments happening globally.
That is interesting. So while some sectors are struggling,
Exactly. Contrast that with sectors like, say, real estate or energy. Their profit forecasts have been lowered quite significantly.
so that difference is really important for investors to notice.
It's critical. It shows you can't just paint all sectors with the same brush. Some are clearly in a better position to thrive right now than others. It's like selling umbrellas in a rainstorm versus selling ice cream in winter. Context matters.
Okay, so you've identified a promising sector like healthcare. How do you then figure out if a specific stock in that sector is a good buy? You mentioned valuation tools, like the PE ratio.
Yes, the price to earnings ratio, or PE, it's a fundamental tool. For anyone unfamiliar, it basically compares the stock's current price to the company's earnings per share.
Right. So it tells you what exactly? If it's cheap or expensive?
Kind of. A high PE might suggest the stock is expensive relative to its earnings, maybe because investors expect a lot of future growth. A lower PE could indicate it's undervalued, or perhaps that expectations are lower.
So lower is better.
Not necessarily on its own. It's all about context. You really need to compare it to the company's own historical PE and compare it to other companies in the same sector. It's a relative measure.
Got it. And you mentioned healthcare seems interesting from this perspective too.
Yeah, that's one of the key findings. The healthcare sector is expecting profit growth around, I think, 18%, which is pretty solid.
18%, okay.
But what's interesting is that despite that growth, the sector as a whole is considered relatively inexpensive compared to its historical valuation levels.
So strong growth and it's not overly pricey. That sounds like a good combination.
It's definitely an attractive setup. Often, high growth comes with a high price tag, a high PE. Finding solid growth at a reasonable valuation is sort of the sweet spot many investors look for.
And are there specific companies within healthcare that analysts are pointing to?
Yes, a few big names come up based on this analysis. Companies like Merck, Eli Lilly, and also CVS Health.
Okay, familiar names. What makes them stand out right now?
Well, they seem to benefit from that combination we just talked about. Strong profit growth drivers think innovation, demand for their products and services, but their valuations compared to their own history or peers aren't seen as excessive.
So potentially good options for diversification with decent upside.
They could be, yes.
Uh,
For investors looking for exposure to healthcare, these might be interesting ones to research further, offering that blend of growth and relative value.
Now, on the flip side, what about those sectors that have traditionally been seen as sort of safe havens, like real estate and energy?
Mm,
Are they less attractive now?
that's a really important point. Historically, yes, they were often viewed as stable income-generating investments, but things have shifted.
How so?
As we mentioned, the profit forecasts for both sectors have been revised downwards pretty significantly. For real estate, rising interest rates make borrowing more expensive, which can slow down deals and construction.
Okay, that makes sense. And energy.
Energy faces different headwinds. There's uncertainty around the transition to renewables, volatile commodity prices. It just makes the environment less predictable right now.
So the old assumptions might not hold true today.
Exactly. It underscores why you can't just rely on past reputations. You have to look at the current dynamics and forecasts for each sector. It's like assuming a raincoat is always useful, even on a sunny day. The current weather matters.
Right. So let's circle back to that potential for high returns. Which specific stocks are analysts highlighting as having that, really significant upside potential?
Well, one name that really stands out in the analysis is First Solar, ticker FSLR. They're a major player in the solar energy space.
First Solar and the potential there.
The analysis suggests a potential upside of over 100% from its current price, which is quite substantial.
Over 100%. What's driving that optimism?
It's largely tied to the growing demand for renewable energy, plus government policies supporting the solar sector. They seem well positioned to benefit.
Okay, that's definitely one to watch. Any others mentioned?
Another interesting one is Nvidia, ticker NVDA. Even though its stock price has dropped quite a bit this year, I think around 33% year to date,
Yeah, it's had a rough patch.
it has, but the analysis suggests its current valuation has become much more attractive because of that drop. And fundamentally, Nvidia is still a leader in crucial growth areas like AI and high-end semiconductors.
So the argument is that the sell-off might present an opportunity for long-term investors.
That seems to be the perspective. If you believe in the long-term potential of AI and advanced computing, the current valuation might be a more appealing entry point. It shows opportunities can pop up even after market turbulence.
It's good to remember. Now, for people wanting to track these stocks, maybe see what others are doing, you mentioned investment tools, something called Blossom.
Yes, Blossom Social Investing. It was mentioned as a potentially useful application.
How does it work? Is it like social media for stocks?
Sort of, but focused on investing. The idea is you can track stocks you're interested in, get access to detailed analysis, and also see aggregated and anonymized portfolio information from other investors on the platform.
So you can see general trends or what stocks are popular.
Exactly. It aims to provide insights and tools to help you do your own research and maybe make more informed decisions. Kind of like combining a watch list, analysis tools, and community insights in one place.
Interesting. Okay, so we've talked potential winners. What about the other side? Are there stocks analysts are suggesting people might want to avoid right now?
Yes, the analysis did flag a couple of names as potentially less promising in the current environment.
Such as?
Examples given were Huntington Ingalls, which is in the shipbuilding sector, and Dollar General, the discount retail chain.
Okay, why those specifically?
For Huntington Ingalls, the concern seems to be around potential impacts from international trade tensions on future contracts. For Dollar General, even though it might seem stable, the worry is about increased competition in the discount retail space, potentially limiting its future growth.
So even if they look stable short term, the long-term growth potential might be capped by these external factors.
That appears to be the reasoning presented, yes. Limited upside compared to other opportunities.
Right. So pulling this all together, it sounds like smart investing isn't just about picking hot stocks. It's about a more strategic approach.
Absolutely. It starts with understanding those broader sector trends, then using tools like the PE ratio for valuation, and critically doing your own homework on individual companies.
So don't just blindly follow analyst recommendations.
Never blindly follow anything. Analyst insights are valuable inputs, but they should be part of your research process, not the whole process. You need to understand why a recommendation is being made and if it fits your own investment goals and risk tolerance.
Makes sense. Combine that sector understanding with careful stock selection.
That's the key takeaway. By combining that macro view of sectors with a micro-analysis of companies and staying informed, you put yourself in a much better position to potentially capitalize on market opportunities.
And for listeners who want more of this kind of analysis, the source mentions subscribing to something called the Smart Investor.
Yes, that was mentioned as an additional resource for those wanting more regular, in-depth analysis and practical advice to guide their investment decisions.
Well, this has been really insightful, definitely a lot to think about regarding a strategic approach to investing.
Hopefully, it provides a useful framework.
It definitely does. And it leads to a final thought for our listeners. Considering these potential shifts in how different sectors might perform, maybe take a moment to think about your own assumptions. What are your current beliefs about the long-term growth potential in your portfolio? And how might this deep dive prompt you to, perhaps, reevaluate some of those assumptions?
That's a great question for reflection.
Indeed. Thanks again for walking us through this analysis. And thank you all for joining us on this deep dive. We'll catch you on the next one.